Lesson 1, Video 2, the history of Forex. In this video, we're going to give you a brief history of the Forex markets. It's important for traders to understand the history of Forex trading and where it all began and the key history economic events that have shaped the markets that we know today. To start off, the barter system is the oldest known form of exchange. It began roughly in 6000 BC. Under the barter system, goods were exchanged for other goods. An example, you paid a membership fee here at Market IQ in exchange for the education, the membership here at Market IQ. You paid a fee to get access to this education and online content. You bartered your money for education. Moving forward, the system evolved and goods like salts and spices became popular mediums of exchange. Ships would sail all around the world to barter for these goods, and this became the first ever form of foreign exchange, meaning one ship would sail from one country to another and exchange salt or spices for different goods or services. Eventually, as early as the 6th century, the first gold coins were produced. They acted as a currency because they had critical characteristics like the portability, the durability, the divisibility, and there was also a limited supply and acceptability of gold coins. Gold coins became widely accepted as a medium of exchange. But the only thing with gold coins is they were impractical. Why? Because they were heavy. If you had your money, so to say, in gold coins, you had all your value in gold coins in your pocket, you'd be leaning like this because gold coins were so heavy. So it was a great start to forming what we now know as our money system and how we use it, everything. And it's all backed and based off of gold and gold coins. In 1876, something called the Gold Exchange Standard was implemented. Basically, it said that all paper currency was backed by a solid piece of gold or gold coin. The idea here was to stabilize the world currencies by pegging them to the price of gold. The gold standard guaranteed that the government could redeem any amount of paper money for gold in its value. So if you had $10,000 in paper money, you could redeem that for $10,000 in gold. The gold standard was ultimately dropped. The precious metal as gold never lost its spot as the ultimate form of monetary value. We still use gold coins and gold as our monetary value today. Everything is we're still basing it off of gold. You can check, and we even trade here at Forex in the Forex markets gold. We'll show you that later on in the education process. But moving forward, the fall of the gold standard is what led us into the next system that was put in place after the gold standard was dropped. The new system we adopted was known as the Bretton Woods system.
When foreign trade began, it was not an international trade market. It was born out of the Bretton Woods Agreement in 1944, which set forth that foreign currencies would be fixed against the dollar, which was valued at $35 per ounce of gold. This precedent was first put into practice in 1967, when a bank in Chicago refused to fund a loan to a professor in sterling pound. Of course, his intention was to sell the currency, which he felt was priced too high against the dollar, then buy it back later when the value had declined, turning a quick profit. After 1971, when the dollar was no longer convertible to gold and the domestic market was stronger, the Bretton Woods Agreement was abandoned, and the currency conversion process became more variable. This allowed for a stronger backing in the foreign markets, and the United States and Europe began a strong trade relationship. In the 1980s, the market hours and usage was extended through the use of computers and technology to include the Asian time zones as well. At this time, foreign exchange equaled about $70 billion a day. More than 20 years later, the trade level has skyrocketed. Trading across international lines was more difficult, with several different currencies involved across Europe. Though the major players in the European market were deeply involved in and veterans of international trade by the time other markets joined in, there were more currencies to keep track of: the franc, the pound, and many more. With the birth of the European Union in 1992, the wheels were set in motion to create a single currency that would be used across most of Europe, and the euro was finally established and put into circulation in 1999. Today, the foreign exchange market is international and worldwide. The market is open 24 hours a day, 5 days a week, to accommodate all of the time zones for all of the major players. These now include most of Europe, the United States, and Asian markets, especially Japan. Even Australia has joined the international trading markets, and since such nations are halfway around the world from some of the other top players, time zones obviously must be taken into consideration.